Most forms of compensation that you pay to employees are subject to tax withholding in the United States, and equity awards are no exception. In this video, I'm going to cover the types of taxes you need to withhold from equity transactions, as well as some of the withholding rules. First, however, a couple of ground rules. Qualified arrangements like ISOs and employee stock purchase plans are subject to tax in the United States, but they are not subject to tax withholding. So the rules I'm going to cover in this video apply only to non-qualified arrangements like non-statutory stock options and restricted stock and unit awards. You also only withhold taxes for employees and former employees. You should not be withholding taxes for non-employees like outside directors or consultants. And of course, you will only withhold U.S. taxes for employees who are subject to tax in the United States. Now, there are lots of other countries that have their own tax withholding rules, but those laws are a little bit outside the scope of this short video. In the U.S., there are a number of different taxes that you will need to withhold on equity transactions. These include federal income tax, FICA taxes, and state and local taxes. As a general rule, any tax that you are withholding from an employee's regular wages also needs to be withheld from their equity transactions. Let's start with federal income tax. For federal income tax purposes, equity transactions are considered a type of supplemental payment, and supplemental payments are subject to special withholding rules. Most importantly, those rules are different when employees have received over $1 million in supplemental payments for the year. Let's start with the more common scenario, however, where an employee has received supplemental payments of $1 million or less during the year. In this case, you have a choice in how you withhold federal income tax. One way to do it would be to withhold at what is called the supplemental flat rate. This is a flat rate that can be applied to all supplemental payments. It's set at the third lowest individual tax rate, so it can change over time as individual tax rates change. And if you withhold at this flat rate, then no other rate is permissible. You can't let employees pick their own flat rate, for example. Your second choice would be to withhold at the W-4 rate. This is a rate that is calculated based on an employee's year-to-date compensation and also the elections that they made on their Form W-4. So this rate can be different for every employee. And it's actually pretty complicated to figure out. The IRS refers to this as the aggregate method because when you are calculating this rate, you have to aggregate the supplemental payment with the other wages the employee has received for the period. And as a stock plan administrator, you probably don't have visibility into those other wages. Because of the complexity in determining the W-4 rate, the overwhelming majority of companies withhold at the flat rate. Where an employee has received over $1 million in supplemental payments during the year, then you have to withhold at the maximum individual tax rate. No other rate is permissible. And just a note on tax rates here. You'll notice that I'm not saying what any specific rates are. And that's because tax rates change over time. And if I say the specific rates, that's going to really shorten the shelf life of this video. But NASPP members can always find out the current U.S. tax withholding rates on the NASPP website. Now let's talk about FICA taxes. FICA consists of two taxes, Social Security and Medicare. Social Security is withheld at a flat rate. The same rate applies to everyone. It's also subject to an annual maximum, and the same annual maximum applies to everyone as well. That annual maximum is tied to inflation, so it can change from year to year. Once an employee has paid Social Security up to that annual maximum, you don't withhold Social Security on any more of their compensation that they receive that year. For Medicare, the rate will vary depending on an employee's year-to-date wages. When an employee has received over $200,000 of wages during the year, you have to withhold Medicare at a slightly higher rate. And there is no annual maximum on Medicare. And then lastly, let's talk about state and local taxes. This can include state income tax, state SDI or SUI taxes, county taxes, and city taxes. Every jurisdiction can determine its own tax rates and its own tax withholding rules. So as you can imagine, the rules here can vary pretty considerably. Not all states have an income tax. When states do have an income tax, some have a flat rate for supplemental payments and some don't. Some states require you to withhold taxes in whole dollars only. They don't take pennies. When trying to determine these local taxes, your payroll team can be a great resource for you because they're already withholding these taxes from employees' regular wages, so they may be able to help you figure out what rates and what the rules are that apply for equity transactions. So those are the basics on withholding taxes for equity awards. I'm going to bet, though, that you have some additional questions, like, can you ever withhold more than the flat rates? Or what happens when an employee moves from one state to another? And I have some additional videos that cover these topics. We also have a whole host of resources on the NASPP website that help you understand the tax withholding requirements in the United States. And we'll post links to some of these resources when we post the video to YouTube. I hope you enjoyed my video today. If you did, please subscribe to our YouTube channel so that you are notified when we post new videos. Heck, even if you didn't, subscribe anyway. Maybe you'll like the next one. Thanks for watching.